What if the biggest crypto story of the week has almost nothing to do with the price of Bitcoin? Because right now, everybody is glued to that $80,000 level, watching Bitcoin fight for its life. Above it, refresh, refresh, refresh. And while all of that noise is happening, Goldman Sachs quietly did something that deserves a lot more attention than it's getting. They kept their buy rating on Coinbase. They kept their buy rating on Robinhood. And they raised their price target on Coinbase from $173 all the way up to $196. Here's the part that should stop you in your tracks. Trading volume across the entire crypto market has been falling. Not a little, a lot. So why would one of the most powerful banks on the planet get more bullish on the companies that make their money from crypto trading at the exact moment that trading is slowing down? That question is going to sit with us for the next 20 minutes. And by the end of this video, I think you're going to see this whole story completely differently than the headlines are presenting it. Because Goldman may not actually be betting on Bitcoin's next candle at all. They may be betting on something underneath it, something structural, something most retail investors are not even looking at. Quick disclaimer before we go any further, nothing in this video is financial advice. I'm not telling you to buy Bitcoin, Coinbase, Robinhood, or anything else. This is analysis and commentary for educational purposes. And you should always do your own research and talk to a licensed advisor before making any investment decision. Crypto and crypto-linked stocks are extremely volatile, and you can lose money. Okay, with that said, let's actually dig into what Goldman is doing and why it might matter far more than the headline suggests. And hey, before we go deeper, drop a comment and tell me where you're watching this from and what the weather's like where you are right now. I read every single one, and it genuinely helps me understand who's actually here with me on this channel. If you're new to the wealth continuum, this is where we break down the moves that Wall Street makes quietly, the ones that don't always make the front page but end up mattering the most a few months later. So stick around. On the 25th of August, 2026, Goldman Sachs analyst James Yarrow put out a note that most people scrolled past in about 4 seconds. Buy rating on Coinbase, buy rating on Robinhood. Price target on Coinbase raised from $173 to $196. Price target on Robinhood nudged up from $123 to $124. At first glance, that looks like a routine Wall Street upgrade, the kind of note that gets published, gets one news cycle, and gets forgotten by lunchtime. But stay with me here, because the next part is where this stops being routine. Goldman made this call while crypto trading activity is moving in exactly the opposite direction. And that contradiction is where the real story actually begins. According to Goldman's own research, crypto trading volume fell by roughly 30% in July. Then it fell again by roughly 21% in August. Goldman's analysts described this slowdown as unusually long, longer than the 5 previous volume contractions the bank had studied. Think about what that actually means for a second. If you were only looking at trading activity, the obvious conclusion would be that crypto is losing steam. Less trading, less excitement, less momentum. And yet Goldman still sees room for that activity to recover, as long as the overall crypto market capitalization holds somewhere around $2.8 trillion. So here's the question you should be asking right now, and I want you to actually sit with it for a second instead of just nodding along. What happens to a company like Coinbase when the market stops, depending almost entirely on trading fees to make money? I'm not going to answer that yet. Keep that question in your back pocket because we're building toward it. Here's where this video goes beyond a simple stock upgrade, and honestly, this is the part most crypto channels are completely skipping over. Goldman's note pointed to something much bigger than spot trading. It highlighted brokerage growth, prediction markets, tokenized assets, perpetual futures, and a wave of new financial products that these platforms are building on top of their original business. Add to that ongoing regulatory progress, including movement around the Clarity Act, and you start to see a very different picture forming. Goldman's real thesis, when you strip away the jargon, is this. Crypto platforms are evolving into full financial marketplaces, not just places where people click a button to buy Bitcoin. And that changes everything about how you should think about the investment case. Because if Coinbase becomes more than a place to buy digital coins, and Robinhood becomes more than an app for retail traders to gamble on stock options, then the entire value proposition stops being about whether Bitcoin goes up tomorrow. It becomes about something much sturdier. Infrastructure, rails, the pipes that money moves through. Here's what they're not telling you in most of the mainstream coverage of this story. The trading volume drop that everyone is panicking about might actually matter less than it did 2 years ago, because these companies are no longer one-trick ponies. Coinbase's event contracts division, the part of the business built around prediction markets, reportedly reached an annualized revenue run rate of $100 million less than 2 months after it launched. Robinhood's prediction markets revenue is projected by the research firm Bernstein to reach roughly $586 million by the end of 2026, up from around $150 million in 2025. Read that again. That's not a small bump. That's a business model quietly transforming underneath the ticker symbol. Comment below if you had no idea Coinbase and Robinhood were already this deep into prediction markets and tokenized assets. I genuinely want to know how many of you are seeing this angle for the first time, because I don't think it's getting nearly enough attention. Now, here's where things get genuinely interesting, and this is the part of the story that barely made it into most coverage at all. In its second quarter filing for 2026, Goldman disclosed roughly $86.5 million in exposure, spread across 5 different spot XRP ETFs. In the first quarter, that same filing showed nothing, no exposure at all. Now, before you run off and assume this means Goldman has suddenly turned into an XRP bull, let's slow down and be precise, because precision is what separates real analysis from crypto Twitter hype. 13F filings only show what a firm was holding at the end of a quarter. They don't show every trade made along the way. They don't necessarily represent some grand, long-term conviction about where XRP's price is headed next year. A position like this could be client-driven, hedging-related, or part of a broader market-making function rather than a directional bet. But here's the part that actually matters, and I want you to hold on to it. This kind of exposure shows that crypto-linked financial products are working their way deeper and deeper into the portfolios of major institutions. This is the difference between Wall Street watching crypto from the sidelines and Wall Street quietly building exposure around it, piece by piece, filing by filing. And that difference is exactly what takes us to the question Goldman may actually be trying to answer with all of this. So now let's put the pieces on the table together, because this is where the whole picture starts to click into place. Bitcoin recently pushed above $81,000, touching a high somewhere around $81,250, before slipping back down toward the $79,000 range. As of the 28th of August, Bitcoin has been trading in that $79,000 to $80,000 zone, up a little over 2% in the last 24 hours alone. But the price bounce isn't actually the most important signal here. The more important signal is what's happening underneath it. Over the past several trading sessions, United States spot Bitcoin ETFs have posted 9 consecutive days of net inflows. That streak brought in roughly $2.3 billion across Bitcoin and Ethereum funds, combined in a single week, the strongest combined week since October of last year. On the 27th of August alone, spot Bitcoin ETFs pulled in $242 million, while spot Ethereum ETFs added $235 million on the very same day. So follow this chain with me, step by step, because this is the logic that actually connects everything we've talked about so far. Bitcoin rallies. That rally attracts ETF inflows. Those inflows represent real institutional demand. That demand supports the overall crypto market capitalization. A stronger market capitalization is exactly the condition Goldman said could bring trading activity back to life. And more trading activity means more exchange revenue for companies like Coinbase and Robinhood. Suddenly, Goldman's bullish call doesn't look so strange anymore, does it? You need to understand this chain before I show you what's underneath it, because there's an even bigger force sitting quietly beneath this entire move, and almost nobody in mainstream financial media is connecting it to crypto directly. This is the macro heart of the whole story, so stay with me here, because this is where it gets really concerning if you actually think it through. Bitcoin's recent rally has been tightly linked to a softer United States dollar, growing anxiety over government deficits, and a notable move by the Treasury to double its purchases of longer-dated government bonds. That single decision helped push yields lower and reignited demand for what investors call risk assets, right as concern over inflation and mounting government debt was already building in the background. Bitcoin is not moving in a vacuum. Gold has been moving. Treasury markets have been moving. The dollar has been moving. And underneath all of it, more and more investors are quietly asking the exact same question. What actually protects your purchasing power if governments keep carrying enormous, growing piles of debt year after year, decade after decade? Now, I want to be very careful here, because this is exactly the kind of moment where a lot of channels start overpromising. That question does not automatically make Bitcoin the answer. It doesn't mean gold is the answer either, and it certainly doesn't mean either of them is risk-free. But it does explain why institutional investors, the same ones managing pension funds and endowments, are increasingly willing to treat digital assets as part of that broader conversation about currency debasement and long-term store of value. So let me ask you directly, if you were sitting where Goldman's analysts sit right now, watching deficits grow and watching the Treasury lean harder on bond buybacks, would you be more comfortable holding cash, or would you want at least some exposure to assets that are harder to print more of? Drop your answer in the comments. I actually want to see where this audience lands on that question, because I don't think there's one obviously correct answer here. This next part matters more than almost anything else in this video, because it's where I want to protect you from misreading this whole story. Goldman is not saying Bitcoin can't fall. It absolutely can, and it has many times before. Goldman is not saying crypto trading volumes are about to explode overnight. Goldman is not saying Coinbase is guaranteed to outperform the market, and it's not saying Robinhood is somehow immune to risk. And regulatory uncertainty has not disappeared. In fact, according to Goldman's own reporting, regulatory uncertainty remains one of the most common concerns among the institutional investors it surveys. This is exactly where we need to separate real Wall Street positioning from the kind of hype you see flying around on crypto social media. Goldman's message here is not Bitcoin only goes up. It's much closer to something like this. The financial infrastructure being built around digital assets may be worth more than the market is currently giving it credit for. That's a very different statement. And it's a far more useful one for anyone trying to actually think clearly about this space instead of just chasing green candles. Let's zoom in specifically on Coinbase for a moment, because the numbers here tell an interesting, slightly messy story. Coinbase closed at $187.16 on the 26th of August, 2026, up more than 21% over the previous week. That's still down roughly 53% from its 52-week high of $402.16, but up about 35% from its 52-week low, near $139. Wall Street price targets on the stock currently range from a low of $148 up to a high of $330, with an average somewhere in the range of $196 to $215. And here's the part that makes Coinbase such a genuinely fascinating case study right now. In its most recent quarter, the company posted its highest ever share of overall crypto trading volume, while also reporting its third consecutive quarterly loss under standard accounting rules. Both of those things are true at the same time. Neither one cancels the other out. So here's the question I want you to sit with, and actually think about it, not just skim past it. If crypto trading stops being the one thing that determines whether Coinbase succeeds or fails, does that make Coinbase less of a crypto exchange and more of a financial infrastructure company hiding inside a crypto wrapper? I'm not going to hand you an answer right now because I don't think there is a clean, tidy one yet. But it's the single most important question for anyone actually holding this stock or thinking about it. Now bring Robinhood into the picture, because the pattern here is honestly even more interesting once you zoom out. Robinhood shares were trading around $111, up roughly 21% since the 19th of August. Think about the direction this company has been moving in. It started as a stock trading app, then it added options, then crypto, then prediction markets, then tokenized assets. It's slowly becoming something closer to a 24-hour, always-on financial marketplace rather than a single-purpose trading app. Here's the bigger idea worth chewing on. Robinhood and Coinbase are not just competing with each other for crypto traders anymore. They're competing for something much larger, which is the next generation of financial market activity in general across every asset class, all in one place. And if tokenization actually scales the way a lot of analysts expect it to over the next few years, the eventual winner in this space might not be whichever company has the highest Bitcoin trading volume on any given day. It could end up being whichever company becomes the default gateway that people use for everything financial, all in a single app. That's a genuinely different way to think about this sector than number go up, therefore stock go up. And I think it's the framework that actually explains why Goldman is staying constructive here, even while short-term trading numbers look weak. Stay with me, because I promised you this video wasn't going to turn into a promotional pitch for these stocks, and I meant it. So let's flip everything we've just discussed and look hard at the risks, because ignoring them would make this whole video useless to you. First, trading volume could simply stay weak. If activity doesn't recover the way Goldman is hoping it will, exchange economics take a real hit, and that hits revenue directly. Second, Bitcoin could fall sharply from here. Crypto-linked equities like Coinbase and Robinhood tend to amplify Bitcoin's downside moves, not soften them. That works both ways. Third, regulation could disappoint. If the progress everyone is expecting around clearer crypto rules stalls out or reverses, institutional adoption could slow down meaningfully. Fourth, valuations could simply run ahead of the underlying fundamentals. Wall Street enthusiasm has a well-documented history of getting ahead of itself, and crypto-adjacent stocks are no exception to that pattern. Fifth, broader macro liquidity could reverse. Higher yields or a stronger dollar could quickly pressure crypto and crypto-linked equities together, undoing a lot of the recent gains in a short window of time. This is exactly why Goldman's signal here is interesting, genuinely interesting, but it is not automatically bullish in the simplistic, oversimplified way a lot of headlines are presenting it. Here's a simple framework you can actually use going forward, something to track with your own eyes, instead of just trusting whatever headline crosses your feed next. Signal number one is Bitcoin itself. Can it hold that $79,000 to $80,000 zone after this recent rejection near $81,000? A clean hold above $80,000 would tell you something very different than another failed breakout. Signal number 2 is ETF flows. Do institutional inflows into spot Bitcoin ETFs keep showing up day after day? 9 straight sessions of inflows is meaningful. Whether that streak extends into double digits or breaks will tell you a lot about how durable this move really is. Signal number 3 is actual crypto trading activity. Does volume finally start recovering after 2 straight months of steep declines? Or does it keep sliding even while the price of Bitcoin climbs? If all 3 of those move higher together, Bitcoin strength, steady institutional flows, and a genuine recovery in trading activity, then Goldman's thesis starts looking a lot more convincing. But if Bitcoin keeps rising while trading activity keeps collapsing underneath it, that's a very different, much shakier signal, and it's one you should take seriously. Which of these 3 signals do you think is most likely to flip first? Type your answer in the comments, 1, 2, or 3, and I'll pin the most interesting responses. Before we land the plane, I want to give you one more layer, because I think it's the layer most videos on this topic completely skip, and it's the layer that actually gives you perspective instead of just excitement. This is not the first time trading volume has fallen sharply while Bitcoin's price kept climbing. Goldman's own research team looked back at 5 previous volume contractions before this one, and in most of those cases, activity eventually did come back once prices stabilized at a new, higher level. That's not a guarantee this time plays out the same way. History rhymes, it doesn't repeat on command. But it does tell you that a falling volume, rising price setup is not some brand new phenomenon nobody has ever seen before. It's happened before, more than once, and the market survived it. Here's why that matters for how you interpret everything we've covered so far. A lot of people watching this pattern for the first time assume it's a warning sign, a sign that the rally is fake or that it's being propped up artificially by a handful of large buyers. Sometimes that's true. But sometimes falling volume during a price recovery simply means that the panic sellers have already left the market. So when the people who remain are holding rather than trading, which naturally pushes volume down even while price grinds higher. So which one is it this time? Honestly, nobody knows for certain yet. Not Goldman, not me, not anyone confidently posting about it online. That uncertainty is exactly why Goldman built in that condition about the market capitalization needing to hold near $2.8 trillion. It's their way of saying, we think this can work, but only if the floor holds. Stay with me for one more thought here, because this is the kind of nuance that actually separates people who make good long-term decisions from people who get whipsawed by every headline. Bitcoin has now had roughly its best August since 2017, according to several market data providers. That's a notable seasonal fact on its own, but seasonality alone has never been a reliable enough reason to make a real financial decision. It's one data point among dozens, not a signal to act on by itself. What are you doing while you're watching this, by the way? Are you checking your own portfolio right now, half listening while you glance at your phone? I genuinely love to know, so drop it in the comments below. It helps me understand how people are actually engaging with content like this, and honestly, it makes this feel a lot less like a one-way broadcast and more like an actual conversation. So let's come back to where we started. What was Goldman Sachs actually telling us with this call? Not that Bitcoin is guaranteed to explode from here, not that Coinbase or Robinhood are somehow risk-free investments, and certainly not that crypto has magically eliminated its own volatility, because it clearly hasn't. The bigger message, once you strip away all the noise, is that Wall Street increasingly sees digital assets as a financial infrastructure story, not simply a speculative token story. That's a meaningful shift in how the smartest money on the planet is choosing to frame this entire asset class. Bitcoin might be the asset that everyone stares at every single day, but Coinbase, Robinhood, spot ETFs, tokenization, and the infrastructure quietly forming around all of it, that might genuinely be where Wall Street is placing its longer-term bet. And if Bitcoin can actually hold above $80,000 while institutional money keeps flowing in week after week, then the real question stops being whether crypto is back. The real question becomes whether Wall Street has already started positioning itself for whatever comes after the comeback. I want to know what you think. Do you believe Goldman is genuinely early here, spotting something real before the broader market catches on? Or do you think this is just another well-timed upgrade riding a short-term price rally that could fade just as fast as it appeared? Tell me in the comments, and don't hold back, because this is exactly the kind of debate this channel exists for. If this video actually helped connect some dots for you, hit like, so this reaches more people who are trying to think clearly about where money is really moving right now, instead of just chasing whatever's trending this week. Subscribe if you want more breakdowns like this one, where we follow the quiet institutional moves instead of just the loud headlines. And if you know someone who's been asking you why Bitcoin and these crypto stocks are suddenly moving again, share this with them, because I think it actually explains the why better than most of what's out there right now. This has been the Wealth Continuum. I'll see you in the next one.